you place your order. Then what happened after some time? Price came further down, took you out, made another push. You try to buy again. Let's say you buy again, and then price grab again, took you out, and then it moves higher. And then you say, oh, I know where was the market heading, but I took early entries. So this is why all of these issues come. Because you are not waiting for the internal liquidity grab after the external liquidity. Hi everyone, I am Harsh, and today in this video I am gonna teach you how to read market structure with basic to advanced. This is your last video, and after that you don't need any kind of video to understand market structure. Just stay tuned. This will be a long video with theory and practical examples, so you get the complete clarity about market structure. Why market structure is important? Because in trading, market structure is everything. Price move because of structure and liquidity. If you want to make money in trading, you need only two things: market structure and liquidity. Rest everything is noise. Okay, liquidity create market structure, and market structure tell us where market is heading. Okay, so let's understand the theory first, because theory is super important. Once you understand the theory, you can clearly understand, you can simply understand the practical. We will after that see examples on the charts, but let's first understand the theory. So this is market structure basics, then we will learn advanced and everything. So what is market structure? So whenever price do any kind of breaks up and down in a form, we call it market structure. People also call it order flow, many different names, but simply this is just market structure. It created with orders and all of that. Okay, so this is our bullish structure, this is our bearish structure. How do we know this is our bullish structure? Because price is breaking upside. Okay, whenever price breaking upside, this is bullish. Whenever price breaking down, this is bearish. This is the first indication of our understanding that where is order flow, right? So wherever is the order flow, we will trade on that direction, so our trades will become higher probability. So this is the general nature of price. So this is the bullish structure, and how price move in bullish structure, it create higher low, higher high, higher low, higher high, higher low, higher high. This is the market natural nature. Okay, how price created bearish structure? Lower high, lower low, lower high, lower low, lower high, lower low. Okay, so we call these as a swing points. So this is our swing low, swing high, swing low, swing high, swing low, swing high, swing high, swing low, swing high, swing low, swing high, swing low. So whenever price break any swing high and any swing point, it will create a retracement. Whenever price breaks swing high, it will create retracement. Whenever price breaks swing high, it will create retracement. Swing low break, retracement, swing low break, retracement. Why it happened? It happened because of liquidity. On every swing point there is a liquidity, and on every major swing lows and swing highs there is a major liquidity, and we call it external liquidity. So this is the natural nature of price, because market moves because of liquidity. So whenever price will grab external liquidity, it will take a retracement. Whenever price will grab external liquidity, it will take a retracement. Liquidity grab, retracement, liquidity grab, retracement. So this is your job as a trader. Whenever price break swing high, you will wait for a pullback. Swing high, pullback, wait. Swing low, pullback. Swing low, pullback. Do not try to trade breakouts. That's why people get trapped in breakouts, because they don't understand external liquidity concept. So external liquidity grab, retracement, liquidity grab, retracement. Alright, so whenever a higher low break a higher high point, this will become our swing low, swing high, swing low. So these levels are obvious and they are clearly visible. You can easily spot them. These are major points. So let's say this is the breakout. From where this break come? From here. So this will be our swing low. This is the breakout. From where this break came, Always ask yourself this question whenever the break happened, from where that break is coming. So breakout from where that break is coming, here or here, from here. So this is the origin, this is internal. We will talk about it later, not now. Okay, so this will be our swing low. So whenever a swing low breaks swing high, that point become protected, because this is the indication that institutions push price higher, because this is a not game of retailer. Retailer cannot push these type of moves. Only institutions and market makers can create these type of moves. So they will protect their point because they injected their money, right? So whenever a swing low breaks swing high, we assume that point as a strong low. Whenever a swing high breaks swing low, we assume that swing high as a strong high. Okay, and whatever the opposite point, we assume this as a weak point. So strong low, weak high. So we will expect market to move further up and take out the again external liquidity of weak high. So this is how market works. So whenever the price grab external liquidity, it will take a pullback and try to grab internal liquidity or external liquidity. It depends on the situation. We don't know in advance what's going to happen. So here price break out external and grab internal, and now it can further push upside or completely downside. It depends on many other things like liquidity and all of the context narrative. But basic understanding of price is whenever the external grab happen, price will take a pullback. External, internal, external, internal. This is how the whole market moves, day in and day out, non-stop. Okay, so this is the basics. Let's summarize the basics. So whenever price did upside break, we call it bullish structure. Whenever price did downside break, we call it bearish structure. And whenever the swing low breaks swing high, we assume that swing low is a strong point. Whenever the swing high break swing low, we assume that swing high as a strong point and opposite point as a weak point. Whenever price grab external liquidity, it take retracement. Whenever price grab liquidity, it take a retracement. The retracement can be deeper or smaller, depend on the situation. Whenever price grab external liquidity, take a retracement. So I hope market structure basics are clear. Now let's move to the advance. Advance are super important because you cannot make money with basics. If trading was that simple, everyone would have made money, right? So now this is the market structure advance. What is the difference between basic and advance? So we all know price don't move like this. Trading is not that easy, right? Price did something like this kind of a structure, back and forth. This type of moves price created day in and day out. So people get lost in this back and forth. They don't know what to take, buy or sell. That's where the confusion came. And to remove that confusion, we need the proper understanding of market structure, advanced structure. Also we call it the QM models. This is the real study. Few people know only about QMs. Very powerful. So as of now, we learned that whenever price breaks swing point, it will take a liquidity and that swing low becomes strong, right? So here what price did? Price did break off structure and after that it grabbed the liquidity. Whenever price after breaking the external structure grab internal liquidity, that point become our strong low. Only then we can say this is the strong low. Why? Price broke external liquidity, then it broke internal liquidity, and then it further pushed upside. So that point becomes strong. This is the indication of manipulation. Price stopped out early buyers or sellers and then it pushed the move. So that point become our strong low. Again, price break external liquidity and then internal liquidity. So this is our range. That's how range formed, and we trade only in ranges. Smart money only trade in ranges. We don't chase breakout. That's why your breakout fail. You try to buy breakout, right? You place your order, then what happened after some time? Price came further down, took you out, made another push. You try to buy again. Let's say you buy again, and then price grab again, took you out, and then it moves higher, and then you say, oh, I know where was the market heading, but I took early entries. So this is why all of these issues come, because you are not waiting for the internal liquidity grab after the external liquidity. You don't know where are your strong points, where are your weak points. So you need proper understanding of strong and weak points. Now you know how to identify strong low and strong highs. For strong low, you need external liquidity grab, internal liquidity grab, and then again break. Strong low, external liquidity grab, internal liquidity grab, again breakout, strong high. Now you can trust these zones. This will get protected 90% times. So this is your key. Whenever price did this type of break, you will do nothing, because you have no surety about that point, it is a strong high or not. But when price do this, then grab internal liquidity, then further push. Now you have surety that point is strong, and retailers got stopped out, other market makers got stopped out. This is a push by institution. This is the VIP area. This is the sign of institutions. All right. Same in the bullish side. Whenever price did breakout, you will do nothing. You will just wait, because price broke external structure, external liquidity. You will wait for internal liquidity grab. You will do again nothing. Now you don't know. People trade these double top and double bottom. They all get liquidated back and forth. And when price did this break again, now you have surety of this strong low, because it grabs sell side liquidity of early buyers and sellers, and then it made a breakout. Now it does not matter if price gave body closing or wick closing. Most people have doubt, oh, we will assume if that body closing come, that is breakout. No, that's not how market works. Sometimes price do wick closing and still it moves on the direction. Okay, so now you understand what is QMs, what is basic. Basic is not useful. You cannot make money with basics. You need QM knowledge. QM models are your main thing. If you want to remember those as a pattern, remember just one thing. Whenever price did this, you will do nothing. You will wait for internal liquidity grab. So that point is strong. You can literally trust it. Breakout, you will do nothing. Liquidity grab and then breakout, you can trust. So you cannot trust simple breaks. You need liquidity grab breaks. Simple break, liquidity break. Okay, so I hope the theory is now get cleared. You know what is market structure basics and what is market structure advanced. So listen guys, I know your brain will not digest this thing. Watch this video 2 to 3 times, only then you can understand, and practice also on your charts. It's tough, it's literally tough in initial, but once you do enough practice, it will get easy. So here is the summary. Whenever price break external breakout, you will not trade. You will wait for it to internal grab, and whenever after internal liquidity grab it break again structure, then you can mark your zones, your order block, your POIs, your fair value gap, whatever the fuck it is, only after the QM. This is the main thing. No one can teach you this. No one. Price grab, liquidity, breakout. Now you can trust this area. This is a strong low. You can only trade after the strong highs and strong lows. Alright. So whenever price give a breakout, you will wait for liquidity grab on the opposite side, and then you can get your range and you can trade between this to this range and you can sell here. Alright, so I hope the theory is now clear. So let's understand the examples on the chart. So let's understand examples on the fucking practical chart, because this is super important. You need to train your mind to see things on the chart, because theory is not enough, guys. So the most common question I get every time is from where we can start our marking structure. Let's say this is the Euro USD 4-hour chart and you have this type of chart right now. So what you will do, from where you will start the marking, the QMs, the swing lows, swing highs, from where? So it is very simple. So let's say this is the chart, and on the chart you have a literally bottom and a complete high, complete low, complete high. Find those 2 points on the chart. Simple. Bottom and top. Once you get this, now you know from where to start marking. So let's assume, so this is what price was down. Let's zoom out chart little bit so you get clarity. So this is the 4-hour chart and we have only this much information. Now how will you mark the chart? So see, price did break of structure, means external point grab, right? We will wait, we will do nothing. Why? Because we know after external structure grab, after external liquidity grab, price sweeps internal liquidity, price further push and swept internal liquidity. Now we will do nothing because we don't know if price wants to continue or further push lower. So now price swept internal liquidity and broke external structure. Now we know price did breakout, grab liquidity and then broke external structure. Now we know this point is protected and we can trade from this zone. Price came out, took internal liquidity and then gave breakout. Alright, so let's mark external liquidity grab, internal liquidity grab, external liquidity grab. So now this is your range and this point is protected. Let's move further. Price continue. We will do nothing after external breakout. We need internal liquidity swept. So prices continue going up and these are equal lows. So here price grab liquidity internal and then breakout. Now we can trust this zone. See what happened here. Now we have this our range. Price grab external liquidity and then price didn't push continue upside, it grabbed at swing low. Alright, now it came lower. After external break we read internal sweep. Price just going and it swept internal liquidity. Once price swept internal liquidity, we know this is our range and we can trust these zones. Alright, and then market push lower. Price grab external liquidity, we will do nothing, we need internal sweep. Price swept internal liquidity, breakout external liquidity and then trend reversed. Alright, so this is our range. Let's see, price break external liquidity, we need internal sweep, external sweep. Now we can trust this zone, then up push, then external liquidity grab, internal, again external liquidity grab. Now we can trust this zone, again push upside. Then this is our protected point. Price broke out, we will do nothing, we will wait and price just keep going and here price just going, just breaking external. Here it took internal, again external. We can trust this zone, again push downside. So now this is our strong high. price took internal no. So this is our strong high, price is continue going, took internal liquidity, so we got our range. This is a strong point, we can trust our strong point, and boom, this happened because of news, and price took liquidity and then dump, broke external liquidity. We will wait for internal liquidity swept, price did nothing, kept going. We will wait for our internal liquidity swept. Here price swept internal liquidity. Now this point is protected, we can trust this. Price kept going lower, swept liquidity, we can short from our protected areas. You could got a good trade. Then same range, price swept our strong area and didn't continue, just swept. So then same range, price did again breakout, and see, after external liquidity grab, it swept internal liquidity. It means this is our new range from this high to this low, right? Price swept liquidity, and you can trade from these areas. Price broke external liquidity, we will wait for internal sweep. Once it swept, we got our new range, and you can trade from these areas. This is failed literally, external liquidity swept, internal, external, you can trust this area. Again price what did, grab external, grab internal, your new range. You could have buy from here, and this trade got failed, and then external grab. Now you will wait for internal swept, and then price will move further downside, because this is just a redistribution and price is rearranging. So I hope you got the clarity about how to market structure. So let's summarize the video. You will not trade breakout. Once price grab external liquidity, you will wait for internal liquidity swept. Once price swept internal liquidity, let me show you. So you will not trade these direct breakouts, you will wait for liquidity swept. Once price swept liquidity, you will wait for again breakout. Then you can trust these areas, because these are your strong lows. This is your QM, right? Similar in downside, you will not trade these, you will wait for this to happen. This is your strong high, this is your strong low, all right? And these are your swing highs, swing low, swing high, swing low, swing high, swing low. This is the only way to avoid traps, and you don't even need proper understanding of liquidity and all of that. Just this much is enough for you to make money. After watching this video, now you will not get trapped into breakouts. You know how market works and how market further push. So guys, if you like the video, please subscribe the channel and leave a comment. It will motivate me to make further videos. Thank you for watching.